episode 59 of Running Greenleaf, where we discuss the nitty-gritty of operating real estate. Today, we're going through some of our retail properties and performance over the past quarter. So let's dig into it. So distributions, start with that one. That's a favorite for everyone, I think.
Distributions are my favorite because that's when we get paid. Like all of our investors get paid.
Yeah.
Usually brings smiles to everyone's face.
Makes people happy.
Yeah.
Distributions are good. So we've got 14 assets over 6 states, soon to be 7. We'll touch base on that, but 14 assets right now, and all of them are making their distributions this quarter.
We're making, just all 100% of all of our retail assets will be making distributions this quarter, which, they do most quarters. So
yeah, that's consistent. We like the net lease space because we're seeing continual distributions.
It's not sexy, but it's a reliable payer. We, typically our business plans work because we know the income, we know the expenses, and it's all laid out for us pretty quick. I mean, it's not sexy, but it makes money.
Yeah. We think about things that have happened this quarter. The only real expenses we have on the retail side are taxes. Tax prep, not property taxes, but tax prep. We got to file our tax returns per entity. That's our main cost. And we don't, on the commercial side or bigger assets, we'll take that cost and spread it across each quarter. On the net lease side, we just expense that in whatever quarter it happens.
Right. So sometimes cash flow might change just a little bit because that one quarter has a $4,000 or whatever tax bill to pay. And it's just part of the business. Yeah. And also part of the business plan too. So when we actually bought this property, this was actually in the profit and loss statement that we're going to have this tax bill once a year. So it's all planned.
Yeah, so those hit this quarter, but as planned. The only other occasion, and we've mentioned this some, is the whole double net lease structure. And we have a few of these. They're prevalent with Dollar Generals.
Dollar Generals, yeah. So we have one Dollar General left, soon to be, because we just disposed of one. We'll talk about that a little bit. And we have a Dollar General in Sevierville, Tennessee, which is it was one of our new states. That was our first deal we closed in Tennessee, correct?
Yeah.
Okay. Yeah. And that's a double net lease. And so we have some parking lot and some roof responsibilities for that one. So we reserve a little bit for that. Yeah. And when we have to do that parking lot repair, if we have to do the parking lot repair or roof repair.
Right. But right now, we're good.
Yep.
So we have that. That's a potential outcome that could happen. But right now, we feel good about it. Everything's making a distribution. So it's a win for the third quarter. You agree, Josh? You think?
Yeah.
He agrees.
Win.
Okay. So another topic we want to cover is transaction volume. And it's kind of like the media presence of like what's happening in the real estate market. In 2022, if you looked at any of the numbers, was stellar, off the charts, highest deal volume that's been in a long time. So some of the metrics right now, we've seen reports, deal volume is down 54%. There's a CBRE report talked about that. Third quarter, down 54% over third quarter of 2022. Some reports are saying down 63%. Some brokers have said down 80%.
Yeah, our mortgage broker has talked about that his brokerage business is completely it's a fraction of what it was last year. So even like mortgage brokers, in addition to real estate brokers, are also having the same issue too.
Well, mortgage brokers are a little bit more unique because I think there's a combination of transactions that are down and also deleveraging that's happening. So like a Dollar General that maybe historically would sell for $1 million, $1.5 million and have 60-70% leverage. Now that debt's so expensive, people are just deleveraging and either taking less debt or no debt at all.
Well, I was saying, yes, a lot of them are paying cash for their $1 million Dollar General. In fact, we're looking at a Dollar General right now that's pretty inexpensive, but it might not even be worth getting debt on.
Yeah. But going back to the trend line here, it's like, so what, probably 2017, 2018 reached the highest deal volume ever in the history of time. And then every year after that, until this year, was the highest deal volume ever in the history of time.
It just kept going up.
And so, even with this pullback here, we're still at a relatively high deal volume if you look at the history of the commercial business.
Yeah, no, I definitely agree. And we got some charts we'll put up to show what that looks like. But yeah, down from 2022, which was the best ever. So we're still seeing opportunities. We're gonna get into some of our buy opportunities later. But yeah, we're still seeing stuff out there. But overall, the sentiment is that transaction volume is vastly different than it was in 2022. Okay, business fundamentals. This is a subject, we're talking about the nitty-gritty parts of real estate, of investing in this stuff, of operating businesses, and we're always looking to partner with people that are operating businesses. We want to understand how that works. We want to know what has to go well and what their challenges are that they could be facing. That's where a lot of our deal flow comes from, operator relationships.
In fact, so the deals we're doing right now, we'll mention this a little bit later too, but the deal we have on the table right now is from an operator partnership. So we have a partner in our network who's buying a very well-established restaurant. They're going to operate it. They're also going to invest in the real estate, and we're actually buying the real estate. And this is all from an operator partnership. It's how we did all our Zaxby's. It's how even Dollar General, although Dollar General is kind of like a small government, we know how to navigate Dollar General.
Yeah, we've bought a few out of their 17,000 that they have.
We know how to kind of go through the Dollar General network to get stuff done too. So that's the nice part there too.
Yeah.
Part of that operator connection, we can basically make win-win opportunities that if we have a good relationship with that operator, we can go to them and say, hey, the way we bought this deal, we can give you a rent discount if you sign a longer-term lease, and then we can basically flip at a lower cap rate and make some money, and puts that operator in a better position long-term.
Yeah, that operator relationship where we're saying we need a little bit of a price discount on the deal, and they need a little bit lower rent on the deal, and that's helping their operations. So they want to find a buyer that can facilitate that for them. So a lot of these conversations, we're going with the tenant on the deal side to say, what are you looking to get? If someone buys this, where do you need to be successful?
Right. And so we love the 2-year lease Dollar General that performs well. And so we turn that 2-year Dollar General lease hopefully into a 10-year lease, and then we sell it at the 10-year lease. And it arguably will go from a mid-7 cap to probably close to a 6 cap, if not at a 6 cap.
Yeah. And we want to see, we're very conscious of rent to sales ratios. So we want to know how the business is performing on a revenue standpoint for what their rents are going to be. And we're always looking at that number, right? That's always in there. So, all right. Exits are always fun.
Exits are fun.
We can talk about making some money and deals that have performed well as we concluded the business cycle. So you want to lead us on some of those?
Sure. So our first exit of the year, which was just last quarter, was our Dollar General Charleston property. And that was that our first Dollar General, or was
I think it was?
Was it our second?
It was really close to our first. If it wasn't our first,
okay, yeah, it was. If there is such a thing, it's a sexy Dollar General in Charleston on a main road. It's been there forever, not going anyplace. And we bought it at approximately a 7.5 cap, and we got a 10-year lease extension, and we sold it at a 6 cap, and we had an 11% IRR return on that, so investors made over 10% on that investment, which, if I could make 10% on my cash, I would do that every year. So I think that was pretty good. And then we had another exit too, which Josh, you found it many years ago, and we're like,
this was his baby. He wanted this one.
So one of our first apartment deals we did was on Edgewood Avenue, and this was on the other end of Edgewood Avenue, right by 85, and it's a bar, but unique that all the bars on Edgewood Avenue were all connected to each other, and there was no parking. So this was really the only bar on Edgewood Avenue that had its own parking lot that was gated. So it was a very interesting, unique deal, kind of a one of a kind in the Atlanta market. And we went for it, bought the property. It was called Black Sheep Tavern.
We don't say that name anymore.
It ended up being Black Sheep of a tenant.
They proceeded to vacate relatively quickly.
Yes. It was a COVID casualty and also a tenant disaster, but yeah. But he should not have been there.
That's where the fun's at, though. We're always looking for what problem can we solve in real estate. As soon as you can find problems, it's like that's where you can create value. And unbeknownst to us, that problem happened. We had our team out there welding different gates and closing things up, but we got a great tenant out of it.
Yeah, and it ended up as one of our biggest wins too. Mm-hmm. I mean, we went from I think it was approximately $12,000 rent a month to $16,000 a month. Mm-hmm. We went to a better quality tenant who knows what they're doing, who knows the community better, and I remember the kicker too in this. We had a swap.
Oh yeah,
swap loan, which was kind of a fun one, but.
Yeah, you want to explain what that means? What are by talking about the swaps here?
Yeah, so when certain banks basically when you fix your loan, they will sell your paper to the market.
Yeah,
so
swaps aren't the easiest thing, but you're basically trading a contract to ensure that you have a fixed rate debt for a longer period of time, and the bank is then looking to offload some of that risk to someone else, and they're using the market to do that, so they can take that to market and then say, hey, we want to trade this interest rate and trade it for another interest rate. Essentially swapping that interest rate.
If you originate the swap at a very low interest rate and then interest rates go higher, the market owes you money.
Yeah, it's almost like an option, in the money and out of the money option.
Right. Yep. So we bought this property for $2 million, sold it for $2.6 million, so made a $600,000 profit. And at closing, drum roll, we got $91,000 extra from the bank for selling, for retiring the
It's one of the few times we've won on one of these. We don't.
We've done a lot of these.
Well, we don't do a lot of swaps. We do a lot of fixed, and then you've got prepayment penalties, or you've got step down prepayment penalties. Typical on the commercial spaces, you're going to see like a 3%, 2% one, or it's called a 3-2-1 step down, and you could have the first 2 years you pay 3% of the principal balance as a prepayment penalty, then 2% and 1%. Some of them are a lot higher than that. You get into things like yield maintenance or defeasance, which can be 10, 12%, kind of these unknown high penalties for exiting a deal.
We're usually paying rather than...
Correct. The seller, you selling a piece of real estate, you're normally paying pre-penalty payments to exit that loan.
Right. No one's paying
Here,
us.
The opposite. So out of 120 deals, we had one win.
Oh, so this is the first time we've ever been paid on a swap.
Correct.
Yes.
Okay. Awesome.
Because for the past 12 years, we've seen nothing but interest rate declines until they were zero, and they can't.
They couldn't go any lower.
And then the discussion was, are they going to be negative interest rates?
So for all of you Greenleaf Triple Net Fund 1 investors, you're welcome.
That was a good one. So 24% IRR on essentially a 4-year hold.
Which is
on that
pretty
deal.
strong for 4 years. Usually those are kind of like short-term holds, but 24% over 4 years, that's
good.
That's strong.
Phenomenal.
Going back to just the specifics of that deal, it was a great location, prime location. It had great access, and it had an opportunity for us to create value. So that's really, if we can, the more of those we can tie into one deal, the better. So that was a great deal. It was a home run for us overall. We're excited. We exited that, and that's kind of the strategy we use across our portfolio. So one of the ones we recently bought an IHOP, and we bought it on a short-term lease, and we're saying, look, we extended it to a 15-year lease. We got a great long-term lease. We negotiated that with the operator, knowing that going into the deal. And now we're looking at, we might exit that.
We're testing the market to see,
what
can this get? And, we went from I don't forget what the actual original lease was, but it was less than 5 years from what I recall. And we moved that into a 15-year lease. So arguably the property is worth, with a 15-year lease, it's worth much more than just a 4-year lease. And, let's see, it's
And that took a relationship with the operator to get that done, because we had that deal buttoned up from the seller side, us as the buyer and the tenant, right at closing.
Right, we
closed with that stuff in place. So
we
that was
closed
a big
the
win.
lease when it closed.
And we've owned it for almost a year now.
Right, and so the year was approximately the time we kind of look at, okay, what do we do now? And let's test the market. So
in the meantime, it's making distributions, and we're happy with it, and it has escalation, so it'll keep going up and performing well.
Right.
Okay, last part, we're going to talk about things that we're buying.
Exciting stuff.
I know there's always opportunities in whatever market you're in to find a problem and solve it. So we talk a little bit about stuff we're looking at right now. We have one Dollar General that we're trying to take down. It's a little guy, but it's exciting.
It'll bring us into Florida. We'll invade our southern neighbor.
It'll be our first Florida deal.
Yeah.
It's a great Dollar General with great demographics, great foot data count. So we're using Placer for this one too, and it's in like the top 70th, 80th percentile, depending on the metrics of foot traffic for Dollar Generals nationwide. So I think that's probably a good Dollar General. It's just outside of Jacksonville. That's phenomenal.
we look at our criteria for buying things. We want to see population growth. We kind of hark on that all the time. We're saying we want to see population growth, and we want to see a deal that in the retail world has foot traffic. It's got to be a deal that people are actively going to. And this one fits that bucket perfectly.
It was a very easy Dollar General. I mean, honestly, I think the way we do Dollar Generals now, we look at it in 3 minutes and figure out whether we want to buy it or not.
Yeah, it's pretty obvious whether it fits in our box.
So they're easy. Once they fit in our box, they fit in our box. In fact, I kind of alluded to this one. We're looking at a very small one, and the very small one is 80th percentile for Dollar General, and it's less than $1 million. Those are hard to make work sometimes because it's kind of funny. It's too cheap to make it work, but it's so we're looking at those kind of deals, and it's I think it was $5. It was $5.
Oh, yeah, like $5.90 rent.
$5.90 rent. Yeah. So that's
pretty cheap.
That's a good one for Dollar General. So they're never going to leave that location.
Yeah. The other option, we're big on the operator partnerships. We've mentioned that lots of times. We think that's the best way to get stuff done.
But this one might be the most exciting restaurant.
It is. This restaurant, right here in Atlanta, it's 2 locations and iconic place. If you know anything about Atlanta, it's super fun to go to and just a cool vibe that's there. So we have the opportunity to buy both locations. partnering with the operator that's there, so they know who we are, we know what they're doing, and we should have that closed in
November.
But
Yeah,
it's a great opportunity to buy.
Just to pique people's curiosity, we are not saying the name intentionally, and if we say the name, it's going to be beeped out. But it's a very iconic brand that if you live in Atlanta, you know the brand. You've been there. You were there in your 20s and 30s. You were drinking, and the original owners are just they're
looking
ready
to move.
They're ready to move on. They're retirement age, and it's an operator partnership that you pulled into the business. That the operator is going to buy the actual business itself. They're going to invest a little bit into the real estate, and then we're going to buy the real estate and manage the real estate.
Yeah.
And it's going to be I always think my Zaxby's are trophies, but I think this one will be a nice trophy too.
So we've got literally 3 parcels that we're looking at buying right now. So we're seeing momentum, we're seeing opportunities, but it's definitely there's going to, tenants need probably a little bit lower rent, prices are a little bit down, right? Because you've got less debt, rates are higher. Everyone knows that right now. So we're seeing, but we're still seeing opportunities. They're out there. There's plenty of things to figure out and solve. So, cool. I think that's a wrap.
I think we're done.
Yep.
Yeah.
We
Okay.
are. We're gonna get back to work now.
All right. I got
Please
3
let us know if you have
o'clock,
any
so
questions.
it's almost-
For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.